Okay, let's now get started. So, welcome to our fifth and final revision session for management accounting. So let's go to the question paper that we're looking at in the last session. So we were not done yet. So let's go and finish it up. So let's go and look at that question paper. Okay, so I think this is the question paper that we're looking at in our last session. And we'd covered up to, should be this question, number 17. So I remember we talked about the three E's for value for money. And also this one, we had done number 17. So the sales volume variance, let's just check our Excel to confirm. Let's check our Excel to confirm the last thing. So yes, the last thing we did was the sales volume variance calculation. So now let's get into today's business. So let's start with question number 17, with question number 18. So this is day 5. Okay, so the question number 18, identify whether each of the following statements about big data analytics in an organization is true or false. I remember talking about big data. I don't know whether it was in management accounting or in business and technology or financial accounting, but some time back, I did talk about big data, where I talked about the characteristics of big data, where I said big data is data that is large, that you cannot handle using manual systems. So if the organization is processing big data, yes, this is when I did talk about big data. So big data is data that is huge, that we cannot process using manual systems. So being in possession of big data is an advantage to the organization because we make better decisions, because if we are in possession of large volumes of data, we can be able to have more information regarding what the market wants. So it means the organization is likely to plan in the right direction. So now so we don't need to go through that again. So let's just go to the question and you help me figure out the correct thing. So identify whether each of the following statements about big data analytics in an organization is true or false. The first one is saying it can improve forecasting to aid decision making. Is that true? That big data can help us when we are making predictions, when you are making forecasts in decision making. It's true, yes, because if we have access to big data, it means we can make better decisions. So the first statement is true. Then let's move on to the second one. It can help provide more detailed, relevant, and up-to-date performance measurement. So being in access of big data, it can help us provide more detailed, relevant, and up-to-date performance measurement. Is that true?
True.
Yes, that's true. Because if you're in possession of large volumes of data, it can give us more detailed analysis of our performance, and also being in access of large volumes of data, we can be able to access up-to-date information. We can be able to access current information. So now let's move on from there. Number 19. A veterinarian should take on average 20 minutes to stitch a dog's wound. In one day, the veterinarian stitched 5 dogs, taking 1 hour in total. What is the efficiency? What is the efficiency ratio? So if we are looking at the efficiency ratio first, how do you calculate efficiency? So the efficiency, if you're calculating efficiency, so let's start with efficiency. So if you're calculating the efficiency, you say the actual output. The efficiency, we are saying the actual output in standard hours. Over actual production hours. Times 100. So efficiency is saying, okay, using your budget, how many hours did you expect to take? Using what you had budgeted, how many hours did you expect to take? Divided by the hours you actually took. So the efficiency is saying, for the actual output, how many hours were you expecting to take? So we need the standard hours of actual output. Standard hours of actual output. So the standard hours of actual output, we are saying, using the budget for the units you produced, how many hours were you expecting to take? Using what you had budgeted, how many hours were you expecting for the actual unit? So for the actual units. So we can say, let's go to the question. So the question was saying that a veteran should take on average 20 minutes. This is the target or the standard. So they are supposed to take 20 minutes to stitch a dog. So each dog, they are budgeting 20 minutes. If we express that in terms of hours, how long would be that? So each dog is expected to take 20 minutes. Or we can work everything in minutes. You can either change, because you're told that the actual hours, it's 1 hour. But the budget for each unit, it was 20 minutes per dog. So in this case now, you can first of all change everything to hours or everything to minutes. You still get the same answer. So I want to compare, for these units that we produce, how many hours were we planning to take? That's the standard hours. Over how many hours did we actually take? So we produced the 5 units. In this case, the units are the dogs that we stitched. So we stitched 5 dogs. We stitched 5 dogs, and each dog, we're expecting that it takes 20 minutes. So in hours, it means we're expecting that each dog, it takes 20 over 60. So dividing by 60, that's changing the minutes to hours. So we're expecting that each dog takes 0.333 hours. That's the time we were expecting for each dog. So for the 5 dogs, it means that for the 5 dogs, we would say 5 times the time we were expecting for each dog. So we can round this to, let's just round to 2 decimal places or even 1. So for each dog, we're expecting that it would take 0.3 hours. So since we staged 5 dogs, the expectation is that these dogs would take a total of 1.67. They would take a total of 1.67 hours. So each dog is taking 0.33 hours. I think 2 decimal places would be ideal because we would need to put this to percent. So we're expecting that each dog would take 0.33 hours. So this is the budgeted hours for each unit. So then the budgeted hours for the actual output, budgeted hours for actual output. So the budgeted hours for actual output, you're saying you're budgeting 0.33 per each dog, but you ended up stitching 5 dogs. So that's 5 times 0.33. So after getting the budgeted hours of actual output, our efficiency ratio then is what? So our efficiency ratio, for efficiency ratio, we say the actual output in standard hours, which is 1.67. So we're saying for the actual dogs that we stitch, if we were using the budgeted hours, how long would we take to stitch these dogs? All this divided by the actual time we took, which is 1 hour. So this is now in hours. So we were expecting to take 1.67 over the hours that we actually took times 100. So the efficiency ratio, the hours we're expecting for the actual output against the hours that we actually took, then you express that as a percentage. So that gives us, if we say 1.67 divided by 1 times 100, so that would be 167%. So that would be 167%. As a percentage, that would be 167%. Now, let's move on. Did we have answers for this one? Let's check. Yes, the answers are there. So C would be ideal. So C is correct. Let's move to number 20. Let's move to number 20. The numbers below have been calculated to use in a linear regression analysis in order to estimate the total cost line for a company. So remember, the regression analysis is a substitute to the high-low method. So the regression analysis is used when we are estimating the variable and the fixed cost. So the regression analysis, it also follows the same structure of the regression of the high-low method. So we are told that with this information, what is the variable cost per unit using the regression analysis? What is the variable cost per unit? So I would want us to go down to the formulas. So here is the regression equation. Y is equals to A plus BX. Y is equals to A plus BX. So in the regression, A is the fixed cost and B is the variable cost per unit. So A is representing the fixed cost and B is representing the variable cost. Is it different from the total cost function? Not really. The only difference is how we calculate the A. If we come back to the total cost function that I gave you some time back, let's go and check the total cost function. Okay, so here is the total cost function, I think. Oh, is it here or what? Did we have anywhere else? Okay, the one that I actually wanted is this one. Total cost is equals to fixed cost plus the variable cost. So this is the same formula. Y is equals to A plus BX. So if we are to put this as in the form of a formula, it would say total cost is equals to A, which is fixed cost, plus bx is the total variable cost. So b is the variable cost per unit. So where then is it different from the high-low method? So this one, how we calculate b and how we calculate a differs. So if you are using the regression equation, watch out how we calculate the value of a and the value of b. So the regression equation is used to estimate. The regression equation is used to estimate the variable cost per unit and the fixed costs in total. So the variable cost is per unit, but the fixed costs are in total. So the equation is in the form y is equals to a plus bx. So y is equals to a plus bx. A represents the fixed cost. Fixed costs in total. So A represents the fixed costs in total. What about the B? The B represents the variable cost. The B represents the variable cost, but this one is per unit. How do you get the value of A and the value of B? For regression, use the formulas to work out A and B. So we are not just going to use we are not just going to say difference in cost over difference in, we are using the formulas for A and B. If you are using regression analysis, you use the formulas. So which formulas am I talking about? If you go to your formula list, you see the formula for B and the formula for A under regression. So here is the formula for A, and the second one is the formula for B. So the one that we want here, the question is asking for the variable cost per unit. So can you jot down that formula? Have that formula down, because I'm going to leave this page and you need to apply this formula to the question. So the B one, just take the formula for calculating B. So that's N summation of XY and summation of XY minus summation of X times summation of Y, summation of X times summation of Y, all divided by N summation of X squared minus summation of X in bracket squared. So what I'm just going to show you is how you substitute, but otherwise the formula is given, the variables are given, so it shouldn't be much of a challenge. So it's just you knowing that if I was asked to come up with the fixed cost amount, I would take A. If I'm asked to come up with the variable cost, that would be B. So let's now go back to that question. Okay, so from our formula, let's check what we need. Summation of X, we need it. So I think let's have these variables down, then let's go to our Excel. Then I'll work it out with you. So summation of X is 251. Summation of Y, it's not 251, sorry, it's 25. Summation of Y is 271. Summation of xy is 550. Summation of xy squared is 65. Then summation of y squared is 30,275. Then n is 15. So we're just going to go to the Excel sheet and apply the formula to those variables. So if you are working out B, if you're calculating the value of B, so the formula that I gave you, if you check, it was saying n times xy. So our n, we're given our n as being 15. You then multiply that with the summation of xy, which is 550. So it's just you substituting into the formula. So it's n times summation of xy. So that's 15 times 550. Then summation of x times summation of y. Summation of x was given. The summation of x was 25 times the summation of y, it is 271. So you then multiply the summation of x and the summation of y. So that's on top. Okay, then below we are going to have what? Below we have summation, we have n times summation of x squared. So our n is still 15. We multiply our 15 times summation of x squared. Summation of x squared was given as 65. Minus, please, I want you to take note of this. If you look at the formula, there is summation of x in bracket squared. Then we are given summation of x squared. So the summation of x squared, which is 65, and the summation of x in bracket squared is different. So the summation of x squared is 65. It means even the x is squared. But for the other one, it's summation of x, which is 25. So you first of all put your 25, then you square the 25. The summation of x, that is 25, then you square. So if you say 25 squared is not 65. So watch out. The summation of x, let me go again to the formulas. So for this one, I'll just leave it here for you to finish up. So take note, this one, summation of x 25 and summation of x squared is 65. So if you say 25 times 25, it doesn't give you 65. So if they say summation of x in bracket then squared, you have to put 25 squared, not 65. So here, so I mean this summation of x squared and summation of x in bracket squared, they're different. Okay, now I'm moving to the next question. You finish up the calculation on your own. So the B value that you calculate, that's your variable cost. If you are able to work out the value of B, that's the variable cost. Now let's move to the next question for the sake of time. Number 21. Over the last 2 months, the following production costs were incurred by Department Z. We are given the level of activity and the production cost. So we are told if the level of activity is 2,180, production cost is 13,405. If the level of activity is 3.2, production cost is 15,700. In July, budgeted production is 2,560. What would be the budgeted production cost? So this one now is application of the high-low method. If they give you different levels of units and different levels of cost, then they ask you to predict the cost. It is likely that they want you to use the high-low method. The high-low method is used to predict costs given two levels of output and two levels of units. Sorry, two levels of output and two levels of cost. So predicting the cost using the high-low method. So predicting the costs using the high-low method. So if you're using the high-low method, the first step is to calculate the variable cost per unit. If you're using the high-low method, the first step is to calculate the variable cost per unit by saying difference in costs over difference in units. So this will give us the variable cost per unit. So going to the question given there, let's go and work out the difference in costs. So our costs were 13,405, 15,700. 13,405, 15,700. 15,700, 13,405. So that's the difference in cost over the difference in units. So regarding the difference in units, so the difference in units, we are saying 2,180 and 3.2. So 3.2 minus 2,180. Minus 2,180. So what would then be our, so we then get our variable cost per unit. So what we get if we say 15.7 minus 13,405. 10?
That's 2,295.
295.
Yes, sir.
Over what about the difference in units?
That's 1,020.
1,020. So the variable cost per unit then becomes what?
$1,275.
Is that possible? No?
Quarter to the last confessions. Maonaji.
The figures that I wrote there is not adding up unless if there's something I wrote which is not true, because we can't have 295 divided by 1,000 and you get, it's 2,295. Okay.
2,225, is it?
Yeah. 2,295.
Yeah.
So 2,295 divided by 1,000, you get what? That's 2 point what? So that's our variable cost per unit. Having the variable cost per unit, we go to our total cost function. Total cost is equals to the fixed cost plus the variable cost per unit, that's B, times the number of units, that's X. So A is representing the fixed cost. They love this one, the high-low method, splitting the semi-variable cost into variable and fixed. B is the variable cost per unit. And the X is the output, or X is the number of units. So firstly, we work out the fixed cost for the levels of units we are given. The fixed costs do not change. The fixed costs do not change. So, sorry, the fixed costs in total do not change. The fixed costs in total do not change. And the variable cost per unit also does not change. So take note of that. The fixed costs in total, they do not change, and the variable cost per unit as well does not change. The fixed cost in total does not change, and the variable cost per unit does not change. We use the given levels of output to determine the fixed cost in total. So we use the given levels of output to determine our fixed cost in total. You take any level. Remember, in simultaneous equation, what we use to do. Simultaneous equation, once you get maybe the value of x, you take any equation to get the value of y. So here you take any level of output to get the value of fixed cost. So what do I mean by that? We can substitute the output 2.180 and the cost 18,405, or you can take 3.2 and 15,700. So I'm going to take the 3.2 and 15,700. So using output 3,200 and costs. Well, and you can hear your background noise, and the costs of 15,700. So using output of 3.2 and the cost of 15.7. So we took the one for June. So having that, you go to your function, total cost, you take the 15.7. Is equals to what? Fixed cost. The fixed cost is what you're looking for. We don't know the fixed cost yet. Plus the variable cost per unit, it does not change. So the variable cost we calculated using high-low method, the 2.25, is the same variable cost we are using, 2.25, times the output. The X are the units. So the units for the cost 15.7, the units will be 3.2. So using your maths, please, can you work out the value of A quickly? Quickly work out A. So you have to multiply with that, then you take that to that other side, it becomes a negative. Can you quickly work out A for me? What is the value of A, which is representing fixed cost? Hello, what is the value of A?
Should be 218.
So it's 218, 11 to 18. Come again.
Be 218.
Okay, are you all getting the same answer? Others, you're silent. How come I'm getting a different answer, sir? So 2.25 times 3.2, then you take it that other side, it becomes a negative.
Yeah, that's correct, sir. 8.5, yeah.
So A is representing our fixed cost. Then we go to our total cost function. So our total cost function then will become what? You say total cost is equals to A is the fixed cost, but now we know the fixed cost is 8.5. It doesn't change, so the total fixed cost is 8.5 plus B is the variable cost 2.25. Then for the function X, you put X representing the unit. So you go to this function, you substitute the value of A and the value of B. So this is the function now that you can use to predict any cost. You can use to predict costs for any level. So this function is then used to predict costs for different levels. Then used to predict costs for different levels. Like then we can say total cost is equals to 8.5. The question had said predict the cost for how many units? Let's go to the question. It had said predict the cost for how many units? So you just change the X and you put 2.5. So in place of X, we put 2.560. So the total cost, what would be our total cost function? 8.5 plus 2.5 times 2. What do we get if we simplify that? Sorry? 2740. We have it on our answers. We only have something like that. Did we make an error somewhere? So it's 8.5 plus 2.25 times 2560. I don't know where Noku is getting 2.7. You guys mukatadza calculator muchandityisa. Please fail because of other reasons, not because of failing to punch the calculator. Okay, let's move on. I think this one I saw it. Let's check the 20, the 14. To 60. Let's go and check. Do we have it on the answers? So that would be A. That would be A. Now let's move on to number 22. So for number 22, we are told that the production machinery of grape company is nearing the end of its useful life. So it's actually close to the end of its useful life. Then it needs to be replaced. Estimates have been made for the initial capital cost, proportional sales income, and operating costs of the replacement machine, which is expected to have a useful life of 3 years. Initial investment would need 500,000. Then in year 1, it would give us sales of 280 after cost of 100,000. Given the data for year 2 and year 3. The company appraises capital investment projections at a cost of capital 10%. What is the net present value? The net present value, this method uses profits in determining which method is the most, in determining which investment is worth placing our money in. So we are dealing with net present value. And what we know about net present value, it uses profits, it uses cash flows. It uses cash flows, not profits. But what do we do provided we are not given cash flows? But let's check. It uses cash flows, not profits. It uses cash flows, not profits. Let's go to the question. We are given income and costs. The question is not given us room for depreciation. So how are we going to work this one out? So the question is says that the sales income and the operating costs. So what they have not mentioned is the cost inclusive of depreciation or not? If the cost includes depreciation, we are supposed to add it back because cash flow does not include depreciation. So if the costs that were deducted are inclusive of depreciation, we add it back. But the question is silent. The assumption is that the costs are excluding depreciation. So we just calculate the cash flow by saying the income less the cost. So the question did not indicate whether the costs are including depreciation or not. So here we can just say, let's first of all work out our cash flows. So we have our year, cash flows, discounting factor, present value. We have year, discounting factor, present value. So the first year is year 0. Year 0 is when you make the investment. When you decide to make the investment, that is year 0. So year 0 is when we are making that payment of 500,000 for the investment. And discounting factor for year 0 is 1. So our present value is equal to what we have paid. Then in year 1, this is where we are expecting to start receiving cash flows. Year 1, we start expecting cash flows from the business. So for our year 1, we start expecting receiving cash flows. So that's for year 1. What do we do? So for year 1, let's go to the question and see what the question is saying. So for year 1, the question is saying that we made sales of 280 and we had cost of 100. So can you quickly work out the cash flows for each year? Simply say sales less the cost, sales less the cost. So the sales less the cost, the sales less the cost, then you get your cash flows. Sales less the cash flows, sales less the cash, sales less the costs, then we get our cash flows. So I'll get the amounts from you just now. So quickly work these out. Okay, so let's now go and get let's get the answers. So what's the cash flow for first year? 180,000. Year two?
210.
210. Year three?
260.
260. Then the question had said that the company uses, oh, sorry. The question had said that the company has a cost of capital 10%. The cost of capital is what we use to find the discounting factors. So we're going to our tables. Of course, on this question paper, they'll be given at the end, but in the exam, you can simply go to that tab where you can review the tables. So 10%, I think for the 3 years, I know that by head. So the first year, it should be 0.909. 10% is a common it's a common cost of capital. So from 0.909, the second year it should be 0.826. The third year it should be 0.751. So through doing this, if you do this for quite some time, you end up knowing these amounts. So let's move on. So the present value, you then say the cash flow times the discounting factor. So the net present value. The net present value, you then say the negative plus the positive amount. So that negative plus those positive amounts. So that's our net present value. So net, it means this is what we get after we have subtracted the negatives from the positives. So these were present values. The net is if we have added up these positives and deducted the negatives, what would be the net amount? So our net present value, let's go and check, do we have the 32,340 on our answers? The net present value, 32,340. So I'll go for A. Let's move to number 23. A company uses marginal costing. A company uses marginal costing. The following variances occurred in the last period when the actual net profit was 80,000. I think we've done quite a couple of questions on this one, where they give you the profit, they give you the variance, then they ask you for the budget. Remember, we said that to go to the budget, we reverse. We add the adverse, you less the favorables. But if you're coming from the budget to the actual, if you're coming from the budget to the actual, let me check whether I did talk about this sometime. Here, budget plus favorable. If you have actual results, you add adverse variances, you less favorable variances to get to the budget. So with that in mind, can you quickly work out this one? I need to hear the answers from you. Quickly, please. That shouldn't take you time, and I don't expect different answers.
Ndinokwenza nini 78,400.
So Bowen is saying 78,400. What about others? Are you agreeing to that? Noku is agreeing here. So I think let's not waste a lot of time on that. Let's move to the next. What is the internal rate of return for this project? So we're given the life of the project is 6 years. The initial cost is 85,000. We are told that the annual savings is that NPV at 5% is 36,824. So what is the internal rate of return to the nearest dollar? So we are given, remember the formula for IRR, this should be, I think, given as well, but you say the rate giving positive NPV plus the difference in rates times the positive NPV over positive minus negative. So I think I gave you the formula some time back again. So for the areas that we covered, I don't want us to dwell much on that. You just need to try to recall. So here is IRR. A is the rate giving the positive NPV. D is the difference. P is the positive. P over. Okay, let's now go to the question. So with that in mind, I don't expect you to take forever. Maybe what I can help you with. The project is said to have annual savings. The project is said to have annual savings. Maybe let's put that in our notes, that savings for a project, they are cash inflows to the business. So if the project has savings to the business, it's cash inflows. So they've not given us the cash flows, but they've given us the savings. So maybe let me just have it down in the notes. So the savings in investment appraisal or capital budgeting, the savings are cash inflows. So the savings, they constitute cash inflows. The savings, they are part of the cash inflows. No need to underline that, but maybe let me just bolden it. So the savings are cash inflows. Then, if calculating IRR and given only one rate, we determine the other rate on our own. So we determine the other rate on our own. We're given only one rate. You determine the other rate on your own. What do I mean by that? Or how, maybe. Yes, you determine on your own, but how? So if given a rate with positive NPV, and they have not given you the optional rate, they have not given you the optional rate. They have not given you the optional rate. You estimate the rate which gives a negative NPV. So they gave you a positive NPV. You need to estimate the rate which will give you a negative NPV. How? The higher the rate, the lesser the NPV. So if you keep increasing the rate, the NPV moves towards negative. So if 5% is giving us a positive NPV, and the NPV is a bit high, so if you check it's a positive NPV and it's a bit high, so you can just pick any rate above 5%. But if you want a rate which gives negative, at least let it be far away from 5%. You can pick any rate, but let it be far away from 5%. But at the same time, remember we have tables. Let it be a rate that you are likely to get the discounting factors on the tables. Let's go to our tables, our discounting factor table. So these ones, yes, these are present value tables. So from 5%, can you see our rates are ending at 20%? So you need a rate which is above 5%, but you can't go for 30% now. It will delay you because, of course, you can use that 30%, but from our tables are up to 20. So the highest, to be sure, we need the highest that we can take here. Let's take 20%. So we are going to use 20%. So we need two rates. We're going to have one rate giving us a positive, and we need another rate which can give us a negative NPV. So this other one you can estimate, but the higher the rate, then the lesser the NPV. So we can use 20%. From what we have been told, the project is saving 24,000 because we need the NPV. So calculate the NPV using 20%. Using the optional rate. So calculating the NPV using the optional rate. In this case, our optional rate, we chose 20%. Calculating our NPV using the optional rate, we chose 20%. So for NPV, we are going to have the same thing we did here, our cash flow. Why not just copy this? So here, cash flow discounting factor is not 10%, it's now 20%. So for year one, always, this is the year when we make the payment. So it's an outflow. For this investment, how much was the outflow, by the way? How much was the cost for this investment? Okay, let me just use the pages. So this is page 19, so that when I'm coming back, I can be faster. So that's page 19. That's why in your exam, they just have that tab close to you so that you can quickly navigate to the tables. So the initial cost is 85,000. So for year 0, not year 1, for year 0, our cost is going to be, it's not year 0, we start with year, it's not year 1, we start with year 0. When we made the outflow, it's year 0. That's negative 85,000. That's year 0. So discounting factor for year 0 is always 1. And the present value is always equal to what we paid. Then, what's the tricky with this question? From year 1 to year 6, the question is saying that the project is giving us the same cash flow each year. It's giving us 24,000. We are not given the cash flows for each year to say year 1, year 2. They just said the project has annual savings of 24,000, meaning that it's giving us cash flow of 24,000 every year. So instead of calculating the discounting factor year after year, what can we do? For 6 years, we can say 24,000 times discounting factor for year 1, 24,000 for discounting factor year 2, 24,000 for discounting factor year 3. That would exhaust you and that would delay you. So what is the faster way? We did mention about that faster way. If the cash flows are the same, what can we do? If the cash flows are the same, what can we do? So if the cash flows are the same, if we are receiving the same amount of cash flows, instead of calculating discounting factor year after year, we use the annuity factor. So we use the annuity factor. So you just take that cash flow, you multiply the cash flow with the annuity factor for 6 years at 20%. So we use the annuity factor. So this is the annuity table and we are at 20%. So you just say for 20%, year 6, it's for 6 years. So you take 3.326. $3.326. So, okay, so then say 24,000 times 3.326. Then we say the present value plus that would give us negative 5176. This is the net present value. But the net present value in this case is a negative net present value. So at least now we can use our formula because now we have the rate giving positive, NPV, the rate giving positive NPV, that's 5%. We have the rate giving negative NPV. So the rate giving negative NPV, we have used 20%. Then besides the rate giving positive, the rate giving negative, we also have the positive NPV itself. The positive one we're given on the question. So the positive NPV, it was given, I can't remember how much it was, but the negative one is what we calculated recently. The negative NPV. So our negative NPV, here it is. So let's go and check the positive one. Then I give you time to attempt the question. The positive NPV, it's given as 36,824. 36,824. Okay, with that, can you now work out the IRR, please? Can you quickly work out the IRR? The formula I gave you last time, the variables I've given you. Now it's just you substituting. Can you quickly work out the IRR? Quickly, please.
18 ndiyo area.
18.
Yes. Amwano chi.
18. Others, I'm waiting for you. Okay, so others, what's your answer, please? So that at least we can agree if we are together. Nyogu? Okay, so the answer, remember, the formula says the rate giving a positive NPV. The rate giving a positive NPV is 5. Plus the difference in rates, you're saying the higher rate minus the lower rate, that's 20 minus 15. So 20 minus 5, that's 15. Then you say the positive NPV, 36,824. Over the positive plus negative, that's 36,824, which is the positive, plus the negative, 5176. Originally, the formula is a negative, but I said minus minus gives us a positive. So you start by working out what is in the bracket. So you simplify what is in the bracket first, which is 36,824. That's 6,824 over 36,824 plus 5176. So you then say that's 5 plus 15 times. So that's 18.15. So something like 18%. Let's go and check on the answers. Do we have any answer close to that? 18%, that's B. Now let's move on.
Hello, sir.
Yes, Bowen.
I just want to ask you,
Yes.
why you decided to use 20%?
Oh, it's just, you just take, because the 5%, it was giving us a positive. So if you want a rate which gives you, because the formula says positive plus negative. So if you want a rate which gives you a negative NPV, you take a higher rate. It's not necessarily that we should use 20%. You can even use 18%. You can even use 15%. But the higher you go, as you can see, but we used 20% and we got 5.176. If we take maybe 10%, it can still give us a positive. So to be safe, to ensure that the other NPV is a negative one, we need the highest rate we can have. So you can pick any rate randomly. So it's not necessarily that you have to take 20. You can pick any, but if the positive one is smaller, let's say 5%, to get the negative, the positive was 36, but at a rate of 5%. If you need a negative NPV, you need a higher rate than 5%. If 5% was closer to zero, let's say 5% was 800. If we take 10%, it could give us a negative one. But since 5% is large, it's giving us a very huge NPV. We need a figure which is very far from 5% to get a negative one. So let's move on. Which of the following are features of activity-based costing? So we have what you call activity-based costing. Activity-based costing. Activity-based costing. So which are the characteristics of activity-based costing? So firstly, we have activity-based costing. activity-based costing. So if it is activity-based costing, this is a costing method. If it is activity-based costing, this is an activity-based, this is a costing method which assigns the cost pools to their cost drivers. So this method assigns the cost pools to cost drivers. So this method assigns cost pools to cost drivers. This method assigns the cost pools to cost drivers. This method assigns the cost pools to the cost drivers. So what do I mean by cost pools to cost drivers? So in activity-based costing, if we are sharing overheads, when sharing overheads, we look at what is causing the costs to go up. If we are sharing overheads, we look at what is it that is driving the costs to go up. What is it that is causing the costs to go up? That's the basis for sharing the overhead. So we don't share the costs equally, but we look at what is it that is causing the costs to go up. So that is a cost driver. If we are sharing the cost of electricity, for example, we say, what is causing the cost of electricity to go up? Then we say, okay, it's because of cooking. So the one who is cooking more should get more of that cost. That is the cost driver. Then the cost pool is the cost that we are sharing. So the cost pool is the overhead that is being shared. The cost pool is the overhead that is being shared. So when we are sharing the overhead, we share the overhead based on cost pool and cost drivers. We share the cost based on cost pool and cost drivers. So you share the cost based on cost pool and cost drivers. Now let's go to the question and see what can we deduce. Which of the following features are features of activity-based costing? I think I've actually given you the answer.
1 and 2.
Yes, it's cost pool and cost drivers. Features are cost pool and cost drivers. Okay, let's move on. Which of the following would not be classified as a production overhead in a food processing company? Which of the following would not be classified as a production overhead?
G.
D. D doesn't qualify to be a production overhead. D doesn't qualify. Yes, D doesn't qualify. Why? D doesn't qualify because D is a direct cost. D doesn't qualify because material is a direct cost. It increases with the level of output. It's not a fixed cost. So if you're looking at production overheads, we are looking at those that do not increase with the level of output. Okay, let's get to question number 27. A company produces two types of tables, the farmhouse, the cottage, the farmhouse and the cottage, which requires 10 hours and 16 hours respectively. The budgeted data for the next period is as follows. We are given the budgeted sales in units. We are also given the opening inventory. And we are told that the inventory of finished goods is budgeted to be reduced to 50% by the end of the next period. What are the total budgeted labor hours for the next period? So I want you to try this. Let me give you the hint. So we are told that for production, the cottage requires 10 hours and the farmhouse requires 16 labor hours. The first thing is to work out how many units are we going to produce of cottage and how many units of farmhouse. So we're given the sales, we're given the opening stock, and the closing stock they've given us. That is 50% of, and the inventory of finished goods is budgeted to be 50%. Is budgeted to be reduced by 50%. So you're saying half of the closing stock, of the opening stock. So we started with opening stock of 1.8. Then the closing stock is half. The inventory has been reduced to half. So it would be 900 units. Then that one would be 1.2. So what are you supposed to do? Can you calculate production? Then you multiply by the hours per unit. So you work out the units that we budget to produce, then you multiply by the time we need per unit. So production, remember, if you're given sales, if you say closing stock plus sales less opening, you can work out, you can get production. Or you can say, you have this formula, I'll give you the formula, but you can play around with this one. If you say what you started with, opening stock, plus what you produced, production, minus what you sold, you get your closing stock. So from that, can you then work out production? You make production the subject, which says production is equals to closing stock plus sales less opening. Then you get the production units and you multiply it by the hours per unit. So let me not spoon feed you further. Otherwise, I will be doing you harm. So can you try first, quickly? So what are the total budgeted labor hours for the next period? Anyone who is done yet?
Hayi niyandidaka.
Badakwa ke bowen wabantu kwabantu. Uchikoro. Okay, let's quickly do it together. Okay, let's move on. What are the total budgeted labor hours for the next period? What are the total labor hours for the next period? So what are the total labor hours for the next period? So for our next period, the first thing is to work out how much is production. How much is production? How much is production? How much is production? So production, you can say, we have two here. We have the cottage and the farmhouse. We have the cottage and we have the farmhouse. So the cottage and the farmhouse. So we have the cottage and we have the farmhouse. So for the cottage, for production, we say we start with, if we make production the subject of the formula, they would say closing stock plus sales. So let's get our closing stock. For cottage, the closing stock is now half. So they said that the closing stock is half of the op. The closing stock is half. That's half of 1.8, half of 2.4. Half of 1.8 and half of 2.4. So 1.8, half of that is 900. And half of 2.4, half of 2.4, that's what? 1.2. This one. Let's move on. So closing stock. Then, so we say the closing stock. Then from the closing stock, we add sales. How much are the sales? Plus what? 7.5 for the cottage, for the farmhouse. What did she?
900 farmhouse.
Oh. Okay, so in case maybe because of our was what in the okay, let's so what about here? The sales is how much? 12,000. So we add that up. 12,000 plus 1.2. Then we less opening inventory. We less opening inventory. This side is 1.8. 2.4. So these are the production units. These are the production units. So from the production units, you then look at the hours. So we are told that each unit for farmhouse is taking how long? 10. So that's 10 times 6.6. Come here. Each unit is taking how long? 16 times 10.8. So overall, how many hours? 238.8. Do we have that on our answers? The instruction to a market researcher is to stop 50 men and 70 women to do the questionnaire. What type of sampling is being used? So it's 50 men and 70 women. Sorry, 50 men and 70 women. 50 men and 70 women. So this one is quarter sampling. So I remember there was one that we were doing yesterday. We'll go back to that. So this one is quarter sampling because it defines the population. So we have a group or a quarter that we are going to be sampling. And for quarter sampling, there is a set number of people in that population. Stratified, so the last one that we're looking at, let's quickly go to that one. I checked that one. In fact, let me maybe just put the explanation here. So for that one, there was cluster and multi-stage sampling. So for cluster sampling, we put the population into groups or clusters. Then we sample every member of the population. But for multi-stage, not every member is going to be sampled. So for that question, it was cluster because everyone was going to be sampled in that population. So for multi-stage, it's more of the same strategy, but for multi-stage, not every member will be asked. So that is that's why cluster was the answer for that question, because the question was saying every member should be selected. Let's look at question 29. Cash budgeting. Let's look at question 29, cash budget. So what is the value of receipts? What is the value of receipts in the month of April? So what is the value of cash receipts forecast in the month of April? What is the value of cash receipts in the month of April? So the cash receipts, if you are looking at the cash receipts, we need to first of all understand how are we paying? How are the customers paying? So it's a cash budget. It is used to determine when are we going to receive the money. So what are the cash receipts for April? So for April, let's go and check how are the payments being made. ABC company sells to both the cash and credit customers. It expects that 40% of its sales will be paid for in cash, and the remainder, 50%, will be paid for the month after sale. 40% of 2 months after sale, and the rest will remain unpaid. So the tricky part about cash budget is just the way they structure the payments. They try by all means to confuse you. But let's focus on the month of April. So in the month of April, what are they saying? It expects that 40% of the sales will be paid for in that month. So let's go to April. April, we made sales of 150,000 and 40% will be received in that month. So it means 40% will be received in April. It was 15,000. Then 150,000. Then we are going to receive 40% this month. This is cash sales. Then for those that are paying on credit, the receivables, they are given terms. Let's check the terms that we have for receivables and group them. The remainder, 50% will be paid in the month after sale. %, 2 months after sale. Okay, of the remainder. That is of the, so if now they pay 40%, the remainder is what? 60%. So they are saying of the remainder, which is the 60% that remains. So if we received 60,000, it means the remainder is what? From 150,000, the remainder is 90,000. And they are saying for this 90,000, 50% will be received 1 month after. So 50% is received 1 month after sale. Then the remainder 40% of the remainder 40% will be received. 40% it will be received when? The 40% 2 months after. And the rest will not be paid. That's bad debts. 2 months. Then the remainder, which is from my calculation, it will be 10% because percent is supposed to add up to 100%. So if of the 90,000, 50% will pay in 1 month, 40% will take 2 months, then 10% will not pay. That's bad debts. So it means we are going to say the 50% 1 month. It means those that bought in April, they will pay in May. But those that will pay in April are those that bought when? So those that are paying in April, it means it's 50% of those that bought in March. So those that bought in March, they will pay in April, the 50%, which is being given 1 month credit. So the first thing is to work out how much was made on credit. Then the 50% of the credit sales for March will be paid in April. So in March, we had sales of 140,000. We had sales of 140,000 in March. In March, we had sales of 140,000. Then we had sales of 140,000, but 60% of it was on credit. So we had sales of 140,000, 60% was on credit. Then of the credit sales, 50% of it will be paid in April. So the question is just tricky, playing around the amounts to confuse you. Then we have 40% being paid 2 months. So those that will pay in April are those that bought in February, and they were given February, March, then they pay in April. So from those that bought on credit in February, 60% bought on credit, but 40% of them will pay in April. So in February, we have sales of 120,000. So we have sales of 120,000 times the 60%. Then we get those that bought on credit. The 40% of that amount will be paid in April. Yeah, the question was a bit, so the 10% is never paid, so that's bad debt. So the cash budget is looking at when did we receive the money? When did we receive the money? So in April, we received something like 130,800. Let's go and check on the answers. Do we have that? So I'm going with B. Okay. You can read the question again. Let me summarize what I understood from the question. Then you read it again. So they're saying, my customers do 40% vari kubhadhara cash, meaning how many are buying on credit? It's 60%. Then the question says, of the remainder, meaning of the 60% vasina kubhadhara, 50% they will pay after 1 month. Then, so it's 50% of the remainder vasina kubhadhara. Then the 40% of those vasina kubhadhara, they will kubhadhara after 2 months. Then the 10% of those vasina kubhadhara, they will become bad debts. They won't pay. Okay, I think let's close with this one. This one, I think I did something similar to this. Can you go back to the recording? Why did I? Because I think 31, we haven't talked about anything on balance scorecard. So I feel we need to discuss about it. So for this one, maybe let me just quickly give you a quick hint from our previous discussion. So if it's not standard normally, if the distribution is not a standard normal distribution, you start by standardizing, whereby you say the X, which is the 90 we are looking for, minus the mean over the standard deviation. If you are looking for greater than 90, let me maybe show you where you can get what I'm talking about. The question is actually similar to, it's much similar to this one. So this one was greater than 80, this one is greater than 90. But in terms of the steps, it's the same. So I think let's not waste much time on this one and talk about something we have not talked about, the balanced scorecard. So the balanced scorecard is a technique which is used to measure performance. Balanced scorecard. So this technique is used to measure performance, but it looks at both financial and non-financial performance. So this is used when measuring the performance of the business. It looks at both financial and non-financial performance. So it looks at both financial and non-financial performance. So it's used to measure performance of the business. It looks at both financial and non-financial. So it says that if you're assessing performance of the business, there are 4 areas you need to look at. There are 4 perspectives. If you're doing good, you can assess your performance in terms of 4 perspectives. So we have the customer perspective. We can look at how good we are doing in terms of providing that which the customers want. How do you measure if you are doing good in terms of customer perspective? You look at the customer complaints, you look at the number of customers that are coming back. So if the customer complaints are low, the rate of customers coming back is high, then you are doing good in terms of the customer perspective. Then besides the customer perspective, we can also look at the internal perspective. How good are we? How are we doing in terms of developing our processes? If we are doing good in terms of our internal processes, it means as an organization, we are improving our processes. So the internal perspective, it looks at, or we can call it the internal processes. Are we improving our internal processes? So if we were taking 10 hours to serve a customer, are we now taking less? How good are we doing in terms of the internal process? How good are we doing in terms of innovation and growth? Are we improving our process? Are we coming up with any new innovative ways? Are we improving our methods? Then lastly is the financial perspective. This is the one that we are used to, where we look at how good we are doing in terms of profit. So the balanced scorecard says, as a business, let's not just look at profit as a measure of our performance. Let's look at how we're doing in terms of the customer perspective, in terms of internal processes, in terms of innovation and growth, in terms of financial perspective. So in closing, time is no longer on our side. Let's look at that. Which 2 of the following are advantages of using the balanced scorecard approach, where we don't just look at the financial perspective, but we also look at other non-financial issues of performance? So performance appraisal is from a wider view. A is correct because we don't just look at financial performance, we look at a wider view. Then managers can easily distort measures to give the advantage. That's not an advantage. easily distort. It means if they are distorting measures, it means they are giving biased information there. Comparison with different organizations is made easier. It should lead to a long-term success rather than short-term. Yes, if you are looking at all these areas, it can help the organization to be successful in the long term. Because sometimes you can make profits while your customers are complaining. It's just short-term profit. They won't come back. So if we look at all these areas, it can lead to long-term success of the business. Okay, looking at our time, I'm afraid for today we had to end here.